Hello everyone, this is Wayman and we are here for Beginner Forex Series topic 2, and today we are looking at understanding the Forex market structures. Okay, this is just how the Forex market runs. We are not yet entering the details, the full details of trading, not yet. These are just basics, okay? We are looking at the structures of the Forex market, how it's built up, what it's made of, and things like that, right? So we are looking at currency pairs. Today we are going to be looking at things like currency pairs, lot size, bid, ask. Yeah, some of those terms you heard me speaking of in the previous video. So currency pairs, the Forex market or foreign exchange always happens when one currency is exchanged for another. For example, if you exchange the euro for the US dollar or vice versa, okay? And there are three major formats where we have the major pairs, the minors, and the exotics. Now, in these categories, they are grouped depending on uh, volatility that, of course, is brought about by trading volumes, how much of these pairs being traded, and then also, of course, movement in the market is all about volatility. So it's basically volatility, like how much of trading is going on between these pairs. So the major, these are the most traded ones. They're very liquid and they have low spreads. We're going to talk about spreads, and then the minors follow the majors, and then the exotics. The exotics usually have wide spreads and their volumes are really low. So people don't trade these. People mainly trade the majors and some minors. Okay? So as you move from the major to the exotics, expect the spreads to increase, movements to be slow. The market moves slowly. Yeah. And then the base and quote currency. So remember, when you're trading, you have two currencies. You have, for example, the Euro USD, there are two. So you have the base. The base is usually the leading currency. If you have Euro USD, meaning Euro is the base, then USD is the quote currency, okay? So the base is the currency you're buying or selling. Remember, in Forex trading, you buy and sell. There's nothing like only buying, okay? You buy and sell. And then the quote currency, it's the currency you're using to buy. So if I want US dollars and I have Ugandan shillings, US dollars is the base currency and UGX is the quote, okay? So that's a good example. Now we have, if you buy Euro USD at 1.1, this means that you have 1.1, so Euro USD, which equals to 1.100, means that 1 euro is equivalent to 1.1 USD. Okay, if you have 1 euro, it's worth 1.1 USD. And this means that if you want to buy 1 euro, you must have 1.1 USD to buy 1 euro. Okay, yeah. So let's look at pips, pipettes, and points. Pips, it's the percentage in point. Yesterday I told you guys this is how the movement of price is measured. Okay, usually for you in the actual world, if you move from point A to point B, that distance is measured in meters, kilometers, whichever units you choose. But in the Forex market, when the market moves from point A to point B, that movement is measured in pips, which is percentage in point. Okay, so when you later on, when you start trading using the MetaTrader, when you start using these tools, which I'll introduce you to, you'll have you'll get to know what this means. Yeah. So how do you calculate pips? It's just the difference between the value or the market price where you are, where you entered, for example, to that price where the market is at currently. Okay, if you entered, for example, at 1.1, if you took a trade at 1.1 and then the market moves to 1.1050, the difference between the two gives 50, which means that's 50 pips. Okay, it's just getting the difference from the starting point to the end point. The difference in that, you get the pip value, or the pips moved by the market. And then a pipette is just a tenth of a pip. Okay, so 1 out of 10 of a pip is a pipette. So if you have 50 pips and you want its pipette, you divide that 50 by 10. You'll have your 5 pipettes. And then points usually it's how the softwares like MetaTrader are designed to read the distance. Okay, it's just the way these like MetaTrader 5, it's the way they calculate their distance. They calculate the market movements in points. So if you manipulate well, it will give you the value in points rather than pips, and then you will be able to convert. So these are terms you need to know before you start trading. And then we have the bid and ask, and then spread. So bid price, it's a price at which the broker will buy from you. And then ask price, it's a price at which the broker will sell to you. So the spread is the difference between the two. So the day you start trading, you see I have these two images. You'll notice there are usually two lines at this point where you're going to execute a trade. So that is the ask and bid. And the difference between the two gives the spread. And if you start trading, you'll notice that each time you press a buy or a sell and look at your trade, initially it's in red. It's like a losing trade. That is because of the bid and ask price. Okay. And then we have lots. Of course, lots, I mean lot size. They are standard, mini, and micro. You really don't need to know. Okay, you need to know them, but you're not going to be asking yourself, wait, am I applying standard or mini or micro? No, you just need to know what a lot size is. A lot size is just how much currency you're trading. So usually on these platforms you're using, you'll start from a micro, 0.01 being the smallest lot. So if you add, for example, 0.05, that means you're also risking more. Okay, it's a unit of risk. Let me explain it that a unit of risk. All this will make sense the moment we start looking at charts. Then we have leverage. I explained leverage yesterday. With leverage, it's that money the broker gives you. Remember, you are able to trade huge volumes of money in the market with a small capital. For example, you're able to flip $10 to 30 to 40 to 50. That's because of leverage. And then margin is just your own capital that you need to open a trade. Okay, so for leverage, you have common ones are 1 to 50, 1 to 100. Some brokers like Xness actually open, they give you options of 1 to unlimited. Though the bigger the leverage, the more the risk. These things help you when you're in winning trade, but when you're losing, come after you like, I don't know. Then brokers and liquidity providers. Of course, these guys are the go-between. They're the guys that link us to the Forex market. Okay, remember the Forex market is digital, it's not real. So these are brokers. And then liquidity providers, these are guys that trade huge volumes of money in the Forex market. The market makers, these guys, they usually don't care. For them, they move the markets because they put in huge volumes of money in the markets, and yeah, they influence. Okay, so liquidity providers, these are banks and institutions. Yeah, so look at brokers like go betweens. I don't want to go into so much details because you as a person, you cannot access that pool, that Forex market pool. So you need a broker to link you to there. So examples of brokers, we have Xness, Deriv. There are so many. Okay, I don't want to stress my brain on that. And participants in the Forex market, who are the people that participate? Okay, We have retail traders, that's me and you. If you finish this course and start trading, that will be me and you. Okay, we are the retail traders. We have banks, these are huge players, central banks, hedge funds, corporations, brokers. So there are so many people that actually participate in the forex markets. Okay, there are so many. Now, like driving, you must understand the system before speeding. Okay, take baby steps before you actually start trading. So keep learning, refer a friend to refer a friend. Let's grow the channel and get more content here. I'll be uploading more videos soon, but in a few days, a few weeks, we shall be getting to the real stuff. Don't miss. Thank you and peace out.